Oscar Health, or OSCR stock, IPO'd at the beginning of March 2021. Now, what is Oscar Health doing? They are a handful of companies that are trying to improve U.S. healthcare industry, and it has a lot of really big problems. Okay, so how could Oscar, one company, possibly help improve the industry, the U.S. healthcare industry? It's about taking modern technology and using these modern technologies like virtual healthcare, using a full tech stack that's built up internally to lower costs and improve member outcomes. Now, keep in mind, this is not the first company that I've covered with a similar mandate. I did a video on Clover Health a few months back. It's currently CLOV stock. That back then it was around 15, 16 bucks a share. I didn't really care for it then. Now it's around 8 bucks a share. And so this is not the first time. This is not my first rodeo covering these types of companies, trying to take on tech and revolutionize the healthcare industry. You know, it's use technology, improve member engagement, improve the member experience, prevent avoidable costs. That's a big one. If you can prevent unnecessary ER costs, that's huge, especially when you think going to the ER, that can cost tens of thousands of dollars. And if you're able to really squeeze these inefficiencies out of the model and have better outcomes for your patients, you could potentially really disrupt all these legacy insurance behemoths that haven't adapted quite yet. So does Oscar have what it takes to sort of unseat the inherent competition and revolutionize U.S. healthcare? Well, they've grown rapidly, and their membership alone in 2020 was up something like 75% plus. It's not clear to me yet that they have what it takes to cut the Gordian knot that is the U.S. healthcare industry. This video does go out to all my Unrivaled Investing Journey subscribers. About that, let's do a quick plug, if you will, where my name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you enjoy learning about potential multi-baggers, please make a point of subscribing. If you're already a subscriber, smash that like button. It really does help the Google algorithm. And if you want to follow my personal journey as I'm looking for potential multi-baggers, types of companies that can go up potentially hundreds or thousands of percent over time, go to unrivaledinvesting.com, click on Journey. Let's dive into understanding Oscar Health, or OSCR stock. And so, first of all, you need to understand the setup in which, what's actually driving all of this, and that nearly 1/5 of the U.S. economy is dedicated to healthcare with lower outcomes. So lower outcomes, a huge amount of the economy going to it with lower quality outcomes than many other countries that are spending a lot less. So this is a big problem. Warren Buffett has described this as effectively a tapeworm in the U.S. healthcare system, making U.S. companies increasingly less competitive. And so here it is, you have Oscar, and they were the first standalone for-profit insurer to enter the individual market in New York in 25 years. So it's exciting to see fresh blood enter the marketplace, willing to try new ideas, try to squeeze inefficiencies out of the system, bring down costs, and improve membership outcomes. That if you can really get that, the lower the cost and improve outcomes, that's like the holy grail. That's what could potentially defeat this tapeworm and bring this figure down. So that way the U.S. economy can be redirecting sources to, let's say, better investments. And so what's the Oscar mousetrap? How are they potentially revolutionizing care? What's their approach currently? So first of all, they sort of say everything needs to start with understanding that they've built up their own internal tech stack that creates some competitive advantages for them, where it makes it easier for them to create better experiences for their members, while Oscar can also more easily find out and root out potential inefficiencies in the industry. Having a tech stack that connects to all these different things, whether or not it's prescription or hospital costs, or what are the patient's charts, or the underlying bills, the doctor bills, having it all in one system to be able to connect it all, use machine learning to track it, maybe you can reach conclusions you may not otherwise have. And one example is using A/B testing, saying, hey, imagine if we for example, used virtual care at this step, or made a point of sort of triaging using this sort of model with this, and having some sort of A/B testing that you can constantly do because you own this tech stack, you've built it up internally. You might be able to figure out, oh, this process is way more efficient. Patients actually get a better outcome this way. And another example of building up their own internal tech stack and how that can have a big impact is they're currently automating 92% of their claims, the medical bills that go through them. They're automating 92% of which that are under $30,000 bills. So that's a big deal when you think about, like, a lot of insurance companies, what they'll do is they'll work with a company like Multiplan, and I did a video on Multiplan a while ago where you effectively work with them, and it's about they sort of push back and try to squeeze out some dollars so that way you have higher profits. Say, actually, this is the amount that we're going to pay. They're saying, look, we are already automating 92%. That's bills that effectively they don't have to send out. They're already figuring out exactly the amount that they should charge. So how does this model work? Now, they repeat that they are a virtual first organization, a virtual first insurance company, using virtual healthcare to triage your needs. And you can see the different types of, here it is in the OSCR app or the OSCR, experience on the web browser. It's virtual primary care, virtual urgent care. Ask us a question for your care team. And so the way to think about with this virtual triaging is once you sign up as a member to OSCR Health, you're assigned a virtual care team, which includes a nurse and a couple of caseworkers. So that way you have a sense of familiarity of people that you can reach out to. If you have a medical question, you can reach them, and you don't have to be worried. And this is something they call in the prospectus, where they're saying, look, you don't have to get worried that if you ask a question they don't have an answer. They will follow up with you and say, hey, we dug this down and here's our answer, or this is what we suggest you do. And so just having a point of contact that's a real individual is really critical, I think, to making virtual really possible, getting a sense of familiarity. Oh, there's this real person at the other end of the phone. There's this team that I get when I become a member that sticks with me throughout me being a member with OSCR Health, with OSCR Health. And it's, covering these different things. Oh, if I am starting to feel, and if you start asking certain questions that, suggest maybe, you have a more urgent problem, well, that's what their virtual urgent care is, where they're like, look, they can potentially get you to see a doctor within minutes. I think the figure they threw out was like 15 minutes. And that is huge in the sense that, what if that helps prevent you from going to the ER unnecessarily? Oh, you know what? Here's a virtual doctor saying, you know what? We can make sure you're having asthma, your inhaler is low. Let's just make sure we get the inhaler to you. You don't need to go to the ER for that. Everyone wins in that. You save big on your potential medical bills. The insurance company, OSCR, would save on their costs. And, if it just sounds like a problem that's easily fixed, why not address that with triaging it correctly? And it also could, potentially save you time where, hey, you've already done this virtual healthcare, this urgent care. If there is a problem, that could be in your record the second you get into the ER or urgent care. If it's deemed, that you need to go, and follow that path up, you may already have that in your records, because keep in mind, it's all built up in their internal tech stack. So the second you get there, they know what's bothering you, or at least they should, unlike having to fill out, oh, here's the paperwork of why I'm in here again, creating a more seamless process. And so, it's triaging, but not just for emergencies, using OSCR's app to help you navigate towards what you actually need. A lot of folks, they'll schedule their primary care physician to ask sort of a general question that then gets redirected to a specialist. Well, what if you can, instead of having to book an appointment with a primary care physician, you just do that virtual care, your virtual primary care. They charge you really low, and in some instances zero, to have your primary care. And this is a big deal, because this effectively redirects you to what the specialists you might actually need. Or if you actually need to go to a primary care person in person, there's some tests that need to get done in person, you can do that too. But having an app direct you to who you can see and give you the control, put you in the driver's seat of who you want to see, that's a big deal. And you'll see why, because this is starting to address one of the core problems of the U.S. healthcare system. One of the core problems of the U.S. healthcare system is that if you go and order a cheeseburger, you know up front how much a cheeseburger costs. If I'm going to McDonald's, this is the quality and this is the price. Not so hot. If I go to In-N-Out, the price is probably just a little bit better, but the quality is like awesome. So you have these sorts of trade-offs when you have a marketplace. You know what you're getting. You go to Smash Burger or something like that, you know what you're getting. Like, oh man, it costs a little bit more, but here it is, the quality's even better. You have these, or Hi-Ho Burger, and you're like, wow, this is the trade-off. So you need to know what you're looking at in terms of a marketplace, and that's what drives capitalism. Is when you have a marketplace that says, hey, this thing is priced at this, and this is the quality you're getting. Personally, I think Hi Ho Burger is the best burger in Los Angeles. Just call it to Hi Ho. But you know, when I look at healthcare, when you're going to see a doctor, you don't know how much what the cost is going to be. You know, like you don't know like what's the bill going to be. You just go to the doctor in advance. Oscar's trying to break that model, and with Here It Is, they're saying, look, we can show you all these different physicians and the prices, like 2 out of 4 stars for the price, $170 average rate per visit, $112 average rate per visit. This is a good cost. You can see they're both within half a mile. You can see the reviews. You know, so they're starting to turn it into a marketplace, and I think that's really valuable for cutting the Gordian knot that is U.S. healthcare. And this is partly because they have, once again, they've built up their full tech stack and can generate real-time cost engine or real-time cost estimates for the patients to size up, for the members to size up what they need and what they want. Doing this, they estimate, has lowered this, and being able to direct patients directly to the specialists that they need versus going to the primary care first. This lowers the membership costs, they're saying, by about 7%. And which is, at the end of the day, this is what the model's all about. If you can find little inefficiencies, squeeze the cost, you get better care and lower costs. If you can get better care and lower costs, that's the holy grail of turning current healthcare system up, right side up, I should say, because it's upside down in a lot of ways, such as the inability to price shop ahead of service. Now you can start price shopping ahead of service, which is what Oscar's aiming to do. And there's more attributes to what Oscar's doing that is right-sizing the industry, such as their 30-day hospital readmission rate. Now, keep in mind, that's a big deal. When you've been in the hospital, that means, you know, you've had potentially something that's very costly, because if you're in the hospital, you should automatically be thinking in the 4 digits. Things are going to be getting expensive if you've been hospitalized. And so you don't want to have to get readmitted, especially if it's avoidable. And so that's, once again, going back to their care team that's tracking you. This is a full tech stack. They see what's going on. They reach out to you. So having that where you get, you know, you've exited the hospital, you have a team that's checking in on you, making sure you're following up, you're medically compliant, ideally lowering the odds that you have to go back into the hospital because, let's say, things, you know, start reversing or you have an adverse event. And so that's why they call out that their readmission rate within 30 days of getting out of the hospital is 6.2% versus industry standard of nearly 14%, so about 55% reduction in the readmission rate. So that is a big deal in terms of how they potentially squeeze these inefficiencies. And that's a big deal for the patient too. It's not just squeezing costs. It's like, hey, if you're able to prevent someone from having to go back to the hospital, they don't want to be in the hospital. Patient doesn't want to be in the hospital. You want to avoid that if at all possible. You know, another example is by going virtual first, they've been able to reduce the number of avoidable ER trips. They think that, you know, by measuring it against sort of a control group, they think they've been able to reduce ER trips by about 13%. And, you know, in some figures, they think that the amount of preventable ER trips is something like 2/3 of the ER trips, so emergency room trips. So this is, you know, you're getting into some really interesting concepts, which is that if you triage, where you talk to virtual, you know, you have a virtual doctor appointment, could that prevent unnecessarily having to go into the ER and rack up, you know, multi-$1,000 bills? That's sort of the crux of this business model and worth thinking about. And that's so far what they're starting to do. And you know, but the challenge with going virtual first is that you obviously can't do everything virtually. And so what they've started doing is over the last few years, establishing partnerships with some of the major healthcare companies. That enables them to grow even faster, leveraging sort of their cost-effective membership model, which is about using modern-day technologies, triaging, figuring out ways to squeeze out inefficiencies, using this modern membership model and partnering up with these companies that have already built out the physician network. So they take your membership model, figure out ways to sort of, how do you make sure this is an efficient way of treating members, treating the people that are paying for your insurance, but also how do you connect? How do you build out the relationship with all the physicians that'll accept your insurance? The way to super scale that or hyper scale that is by working with the companies that have already established a relationship, or insurance companies even, companies that have already established a relationship with that physician network. And so here it is, that's what they've done. You see some of the names here like Cigna, Holy Cross, Memorial Healthcare System. This is a really interesting model where Oscar's recognizing, hey, we're specializing in sort of the front end of how the member experiences it. And if we can figure out ways to make that a better mousetrap where the patient goes through the system in a healthier way, then we should use the infrastructure that these other folks have built, at least until we're at scale. And we're going to sort of use this as a tool to help us get to scale. So that way we can cover more and more people faster. I think this is a very clever way to sort of accelerate their growth by having these partnerships. Now, and you could see how their growth is done over time. Let me shrink myself a little bit here, where you can see from 2014, they were at 15,000 members. Now they're at 529,000 members. So this is fantastic growth rate that they put up, 75% growth in 2020 alone. And their direct policy premiums grew from 1.3 billion to 2.3 billion in 2020. So that, if you're going to think about the business model, like I would argue, that's the figure you should think about. There is an aspect of reinsurance, and that's why you might see like, well, wait a second, their net revenue after reinsurance declines. I would arguably focus on the policy premiums growing over time if you really wanted to dive into thinking about the business model over time. And the reality is, like, not only are they able to get this hyper growth, but members also seem that the underlying members at Oscar Health do seem to like it better than the industry average, as they have an NPS score, or net promoter score, of 30 versus an industry average of 3. And so that is pretty good. That's not amazing. That's not like the 40, 50, 60, 70 that you might see at a company like Tesla or Apple, where people love the product. Here it is, a net promoter score of 30 means about like 30% of the time people are saying, yes, I would recommend you to others. I would recommend Oscar Health to my friends. So it's not, but keep in mind, something like 3 or closer to 0, that effectively means the amount of people that are promoting you are offset equally, by the people that say, yeah, I would not recommend this service. So having a positive net promoter score like 30 does make it a little bit easier for them to grow, but it also does suggest that they're doing something right, where members feel taken care of. And ultimately, if they're able to crack this nut, the healthcare market, it's obviously this huge market, $100 billion plus market, with several different subcategories like concierge health, telehealth, claims management, just general population health. So this is $100 billion plus market that they could be tapping into and potentially succeed. And they're growing hyper fast, 2.3 billion in premiums in 2020. So, there are early indicators that things are going well. The challenge here is that even at $2.3 billion in premiums, they're still not at scale, not by a long shot, as their combined ratio, and that's sort of a way to think about insurance companies is, you have your medical loss ratio, and then you sort of have your administrative expenses. So their medical loss ratio, they claim, is around 85%. Then you have to throw on your administrative costs. And keep in mind, that's all this tech that they're building out and, figuring out, hey, how are we going to, process claims and all these different things. So that, puts them over 100%. So if you are at 100%, that effectively means you're at break even. When you go above 100%, that means you're losing. And you want to ultimately be at a below 100% combined ratio when you're an insurance company. And that's the challenge here, where they just are losing a ton of money. I mean, negative 400 million adjusted EBITDA the year before, negative 200 million. So it's challenging setup, especially when you're looking at a company that's, $5-6 billion market cap, looking at these types of losses. Yeah, it's great to have, this sort of growth, in membership and policy premiums. But, are they really going to be able to squeeze enough of these inefficiencies out of the system to make their current model sustainable? Is what they're doing sustainable? And it's just not clear to me yet. So when I think about valuation, normally I put together a sheet where I say to go like low, mid, high. when I look at something like this, it's honestly, I personally think it's too tough for me to really, get excited about or pencil out like this risk reward valuation. I would love to see them execute in the years ahead and prove out their model, really start showing, getting into break even, getting into profitability. And keep in mind, like, a lot of investors have had FOMO or fear of missing out over the last few months. But the reality is investing, as I call out, it's a journey. It's a multi-year, multi-decade process. It's about being in the game over a long time period. And so if they're a success, this will not be an overnight success story. This will take years and likely decades for it to play out if they truly have figured out the code that's going to sort of revolutionize the US healthcare industry. So if successful, it'll become increasingly obvious why, and they'll be able to lean into their strengths. As an example, if you think about Geico, which has, taken share consistently, over the last few decades. Geico is one of the largest auto insurers in the US. Warren Buffett calls out, like, look, because of our cost structure, because of our business model, we're generally able to underwrite insurance at a lower rate and thus take market share each year. It's very obvious. I can write it down with a crayon and make it so that you understand why this model is going to win over time. With here, it's still not clear to me why Oscar's going to definitively win in the years ahead, how their business model gets sustainable. Now, if they start posting something like 30% plus growth and they're at break-even profitability, then I start scratching my chin going, that's an interesting setup. When it's burning hundreds of millions of dollars, that's a lot tougher of a setup for me to sort of stomach. I'm not sure yet that the cost savings are material enough really to move the needle. The things that they've sort of figured out, the inefficiencies that they've caught. Am I optimistic? Am I grateful that Oscar is trying to come up with new ways and try to give, let's say, price transparency to its members? I think that's wonderful. I think that's a step in the right direction, because ultimately the big problem the US healthcare industry has is it doesn't have consumer buy-in. Consumers aren't shopping like they would shop for a cheeseburger. They're shopping like, hey, I just want to get treated, and they're not realizing, wait a second, going to this physician is going to cost more than if you go to this physician. You need to have buy-in on the individual basis to break this problem. And I think Oscar's starting to make the right steps, and they're also doing it in clever ways with virtual triage. So, I think what they're doing is right. But, once again, the comparison to Geico. Geico made it clear, Buffett calls out in his letters, like something like 30% of the time, if you check their quote, you're going to be able to get a lower quote than what you're currently using for auto insurance. Whereas for them, they're calling out the lowest price plan. They're only the lowest price plan like 10% of the time in 2020. Now, I think it was closer to 30% of the time in 2019. But hearing that, like, they would sort of spin that as like, well, isn't that great? We're still able to grow really fast and only be the low cost plan 10% of the time. Whereas I would rather your value proposition be so clear that you are the low cost player and you have a better model and you're getting better outcomes. So that's the setup when it becomes obvious, like, oh, this is going to be a success. I'm watching them be successful. I'm watching them prove their business model. And then at that point, I can start getting a sense of what their margins actually look like at maturity. Here, it's just a little bit too hard for me at this point. I'd love to see them continue to execute, to learn more. And look, once again, it's a journey. So if Oscar truly is the one that's going to revolutionize US healthcare, there will be many stops along the way in this journey where you're going to say, oh, they're doing it. Here's the profitability, here's their growth rate, and then you can get in. Now, if you aim to be a venture investor, then I'd argue, that you could sort of say, hey, Oscar might be more of my type. For me personally, I like looking for potential multibaggers where the business model, I think, has already proven themselves out. You do have hyper growth, and so you have a business model proving itself out. You have hyper growth, or you have a business model that's good free cash flow, and maybe you just get adequate growth, and where and it's priced at a very reasonable valuation. And for those types of companies, I have actually called out a couple of healthcare companies recently. One was a smaller company in December 2020. That was my potential multi-bagger. Then in March, so this month, March 2021, I called out another. The first one was an international healthcare company. Today, March is a U.S. healthcare company, and then I called out another healthcare company. So actually three that have different types of profiles where I think it has risk reward where you start penciling out, oh, okay, maybe downside 10-20%, maybe upside of 100-200% over time. And those are the types of plays that I'm looking for as potential multi-baggers, looking for the types of companies that I think can compound and potentially go up hundreds or even thousands of percent over time. And the trick is, in my opinion, finding companies with an unrivaled value proposition. Because when you are unrivaled, it gives you the right to win. It gives you the right to take share. And that's hence the name of this channel, Unrivaled Investing. And that's sort of the big takeaway with unrivaledinvesting.com. If you go to Journey, you can see that exclusive content, the multi-baggers I call out each month, the educational content. The catalog of content of all the exclusive posts are in the description of this video. I also now have a Discord feature where you can go on there and chat with fellow members of the community, and finding just one potential multi-bagger can change your life journey. So if you're interested in following my journey as I try to find these potential multi-baggers, go to unrivaledinvesting.com, click on Journey. And if you enjoyed this video learning about OSCR Health, please make a point of subscribing. If you're already a subscriber, I do appreciate that thumbs up. Thanks so much for watching.